Hello and welcome to Donut Investment. This analysis is for ICICI Bank on the New York Stock Exchange as of 15th of August 2026 with a share price of $29.74. The full report is on donut.ca. Price to tangible book of 2.75x against a warranted 1.93x is a ratio of 1.42 inside the expensive band, and the valuation ceiling gate caps every horizon. Start with the business, because none of the argument is with it. Return on tangible equity is 16.2% and the cost-to-income ratio around 40, the best combination among India's large private banks. Net interest margin is 4.4% and return on assets 2.11. Asset quality is close to as clean as a bank's gets. Gross bad loans 1.38%, net bad loans 0.35%. And it is still taking share, growing its loan book 19.6% against system credit growth of 18.6%. The Indian credit cycle firmed this cycle too. The central bank held rates and raised its growth forecast to 6.7%. 3 weeks on, nothing has crossed a boundary. The horizon scores are literally unchanged at 60, 61 and 67. What changed is the quality of the evidence underneath them. Business quality reads 83 against 85, and that is a methodology change rather than a deterioration. The moat score actually rose from 68 to 70, and the industry benchmark from 90 to 92. The fall comes from this run, applying an explicit weighted build where the previous report scored the pillar holistically. It took 2 rounds of independent audit to get that explanation straight. The first rewrite still named causes that had moved in the opposite direction. The valuation anchor was rebuilt this run on a stricter basis, and the listed subsidiary stakes were priced from the market rather than from a ballpark. 2 inputs were refined and they pull in opposite directions. The equity risk premium moved down, which raises the warranted multiple, while the return on tangible equity was re-derived slightly lower, which lowers it. Net, the warranted ratio improves from 1.47 to 1.42. Closer to the line, still the wrong side of it. And one gap in our own framework disclosed. Our rules cap terminal growth at 3%, a figure calibrated to dollar economies, while this anchor is built in rupees. We use 6% instead. On the literal 3, the ratio would read 1.72, more expensive, not less. The bear comes off the central bank's own list. Its August statement flagged elevated food and fuel inflation, manufacturing cost pressure, tariff risk and an uncertain monsoon. Though the same statement cut the inflation forecast, which is evidence against this branch and part of why it carries only a 20% weight. If oil stays near $83 in an economy importing about 85% of its crude, the central bank is forced back toward hiking, credit growth falls below 12% and the rupee slides toward 100. Alongside it, the deposit war. Axis is compounding deposits at 18.2% against a system credit-to-deposit ratio of 82, which forces this bank to pay up for funding and compresses the margin. And the currency is a standing risk for a dollar holder. A rupee at 100 costs about 4.5% before the shares move at all. Now weigh the risk against the reward. The bull case is roughly 24% above today, the base case, the most likely, about 9%, and the bear case, a fall of about 16%. So you are risking about 16 to make 24. So, our call on ICICI Bank on the New York Stock Exchange. Hold on all 3 horizons. Remember, this is for education, not financial advice. Always do your own research. This analysis is by Donut Investment at donut.ca. The link to the full report is in the notes below. Have a great day.